Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer, and Ben Poole, Writer at CTMfile. Welcome to this episode of the Open Treasury podcast, Paul and Ben.
Hey, thanks, Push. Appreciate you having us.
Great to be here, Push.
Oh, you're welcome. And may I convey my very big thank you to you both for taking the time to share your perspectives with us on topics that impact the world of corporate treasury management and beyond. Let's dig deeper and get your thoughts on our topics for today, namely the digital dollar project pilot finds cross-border payment potential in CBDC or central bank digital currency, CFOs' role undergoing significant changes, Fitch downgrades US credit rating, global fintech funding and deals drop in 2023, and finally, tax transparency among top priorities for multinational corporations. Let's begin the discussion by delving into the exciting world of central bank digital currency or CBDC and their real-world applications. In today's episode, we are taking a closer look at the recent pilot study conducted by the Digital Dollar Project in collaboration with Western Union, BDO Unibank in the Philippines, and Accenture. Participants in the study designed and configured a platform leveraging distributed ledger technology or DLT to stimulate the payments infrastructure necessary to transfer digital dollars to Philippine pesos. The findings have been published in the Digital Dollar Project's white paper, Retail Cross-Border Remittance Payments. Ben, if I may start with you, given that you covered the story for CTMfile, what in particular caught your attention in the Digital Dollar Project pilot, and how might that impact corporate treasury and international payments in the near future?
Thanks, Push. Yeah, I think it's a topic we've touched on a little bit before in terms of innovations that are trying to solve the problem of cross-border payments, and how do you get them transparent? How do you get them faster? And just basically try and get that domestic experience cross-border. There's a lot of innovation going on in the CBDC space. A lot of this is sort of pilots, test cases. And, I suppose the end goal is allowing entities to directly hold and transact in CBDCs from different jurisdictions could reduce the need for intermediaries in cross-border payments. So you're getting faster delivery of payment and fewer costs. But also we need to do this in a way that preserves the security and the resilience of the payments as well. The Digital Dollar Project is one of the latest to kind of report findings that we've seen. And I thought it might be quite helpful to just take a step back and note a couple of the other innovations and projects that we've seen in this space quickly, just to kind of give a picture of what's happening around the world. If we've got time for that, I'll just do a couple. So, back in December 2021, so less than 2 years ago, but still a little in the past, we had the Bank of International Settlements, or BIS, and the Banque de France and Swiss National Bank conclude the successful cross-border wholesale CBDC experiment Project Jura, which was looking at the direct transfer of euro and Swiss franc wholesale CBDCs between French and Swiss commercial banks on a single DLT platform operated by a third party, which is interesting because issuing wholesale CBDC on a third party platform and giving non-resident financial institutions direct access to central bank money raises really interesting and quite intricate policy issues. So Jura was exploring a new approach, used things like subnetworks and dual notary signing, which was, hoped to give central banks comfort to issue these wholesale CBDCs on a third-party platform. So that's one example. We've also got the likes of Project Dunbar, which was the central banks of Australia, Malaysia, Singapore, and South Africa, again with BIS. Project M-Bridge is quite a famous one with, again, the BIS Innovation Hub in Hong Kong, with the central banks from Hong Kong, Thailand, China, and the UAE working together to build a multi-CBDC platform. And earlier this year, we had Project Icebreaker conclude, which was, again, BIS and the central banks of Israel, Norway, and Sweden, studying the potential benefits and challenges of using retail CBDCs in international payments. So all of these projects that are going on, and that's just a few, like there's a huge list. If you go on the Bank of International Settlements website and look at their projects, it's amazing the details that are there. But every single one of these projects, and the Digital Dollar project is the same. They have a very specific goal in mind and very specific corridors that they're looking at. But by and large, they seem to have achieved what they want to do. We saw with the Digital Dollar project, they were pointing out, okay, well, here are 4, I think it was, use cases that we've kind of identified that will work in this certain scenario. I suppose one thing to remember is that doesn't mean we're all going to be transacting cross-border with CBDCs before the year is out. There's still a huge amount of work to do, particularly around sort of the legal and governance frameworks that infrastructure will depend upon. But it's definitely moving in the right direction, right? We're getting some traction. We're getting a lot of people sort of coming to similar ideas all around the world. And I just think it's quite an exciting space to look at the moment, but something for treasurers to monitor perhaps rather than take any action on at the moment.
Yeah, Ben, all great points. Nice color on some historical feedback over the past couple of years. When we think about the CBDC market that is really in its infancy, it's developing. The positive thing about utilizing a platform, a DLT platform, is, these benefits that they noted, the ability to reduce costs, optimize your risk, reduce it, and provide a better customer experience along with visibility. But these reduced costs are significant. We're talking about, new payment rails that are being created. And how many decades do we go without anything new? A long time. Today's world, we're literally moving at the speed of light. There's new things coming around almost, daily in some cases. When you have technology like this, what's the adoption rate going to be? You think about adoption rates. There's going to be some groups that are going to adopt quickly, some that are going to sit on the sidelines to see what happens, and then there'll be another group that they're just holdouts. And for various reasons. One, they just maybe view new things as too risky to jump into without knowing enough. What could go wrong? What does go wrong? How do you mitigate those kinds of risks with a new platform, new technology? Or there could be other reasons around why they don't make that jump. I don't think there's any denying that the use of DLT for payment rails is going to become more and more prevalent. It does reduce costs in a significant way. And cost reduction is something that Treasury is going to become more and more focused on as technology develops. We're going to find faster, cheaper ways to do things. FedNow is out in the market. We know that's fast. We know that's cheap. We're going to see more and more of these platforms come out here. The acceptance and adoption rates associated with central bank digital coins will be an interesting one. In the U.S., we talked about last week how survey revealed that in the U.S., the willingness to move to CBDC is rather light relative to our Asian counterparts, which are really advancing in that area quite quickly. I think there's just a lot more to be understood and known about this. We will have those quick adopters. We will have groups that will gravitate towards this quickly, and that's going to be a great learning experience. I just like the idea that we're coming up with new payment rails, new ways of doing things. And not only is it faster, not only does it provide greater visibility and reduce your risk, but it's cheap. I like that. If I'm a treasurer, I like reducing my costs any way I can, because in today's world, digital payments, that's the name of the game in the future.
Definitely. And I think, we're only about a month out from this year's Cybos conference. So I imagine there'll be a lot of announcements there in terms of some of the more exciting fintechs and what they're doing, and perhaps some kind of hookups with central banks and commercial banks as well, obviously, in terms of maybe not CBDCs, but just in terms of DLT specifically, which you mentioned as the platform. I think is the credibility for that platform has sort of been underlined in recent years, and a lot of the different pilot projects that have been exploring what banks can do with that. So we're probably going to get quite a big news dump in just over a month.
Yeah, no doubt.
Well, that was quite a fascinating perspective from both you, Ben, as well as Paul. And for more on the digital dollar, I would request our audience to review the interview that we conducted with Jennifer Lasseter, Executive Director of the Digital Dollar Project. This interview was published on CTMfile in December 2022, and I would request our audience to review the interview because there was a lot that she mentioned about what they had planned and what she thought was on the anvil. Moving forward from the world of central bank digital currencies into the world of chief financial officers or CFOs, our next topic for discussion revolves around the shifting role of CFOs as the urgency of digital transformation becomes increasingly paramount. The role of today's CFO is undergoing significant changes and expansions according to the evolution of order-to-cash research conducted by global market analysis and advisory firm IDC on behalf of Billtrust. The study, administered to 622 business executives, highlights the growing importance of CFOs in managing cash, supply chain finance, insurance and commodities while working with more limited resources. Amid ongoing economic uncertainty, 90% of the respondents agreed that the CFO's importance has significantly elevated within their organizations. This trend holds in the US and Europe, where nearly 90% of respondents acknowledged the increased significance of the CFO. Paul, as someone who has extensive treasury experience, my question to you is, the study emphasizes the importance of digital transformation in the order-to-cash process for improved efficiency and cash flow optimization. How might the insights from this study influence corporate treasury's approach to adopting digital tools and technologies in various aspects of cash and treasury management?
A couple of things perhaps to unpack or unload here in regards to this. I mean, there's no doubt that CFOs have a lot more pressure on them today to manage and produce and do it in a more efficient way. That certainly trickles down to treasurers. I know we've talked about this at the treasurer level multiple times. It's not going away, with more emphasis at the CFO level, who oversees quite often treasury, accounting, and other financial operational aspects. The movement to digital is becoming faster and faster, or the requirement to move there. I've seen out there that treasurers are chomping at the bit to build out FP&A teams to provide greater fluency and understanding of what forecasts look like, build out of better operations side for budgeting, incorporating this information into various models that CFOs have purview to. So you think about not only is the CFO ensuring that the financial reporting of the company is true and fair, they also are responsible for the management of cash, sometimes investments for companies, and rely on the teams underneath them. Well, you got to bring all this stuff up to a level where you can have visibility. And visibility, doing manual processes, is not going to provide the CFO with timely information. It'll provide them with information, but it won't come in a timely manner if they're running manual processes, because it will just take too long. So the demands on the CFOs today are, we need this information today. CEOs are asking them, are asking their CFO and their treasurer, hey, what's our capital position? What's our access to liquidity? What are our existing banking relationships like? Can we leverage them to do A, B, or C? Especially if you have aggressive CEOs that are looking at expansion either through product development or acquisition. It could be a combination of the two, and oftentimes that involves raising capital to fund some of those types of activities. It may be that the growth of the business has been at such a level that the organization is looking at the return on or return of capital, and the CFO tries to manage those pieces. What should our dividend policy be? Should we buy back shares if we're publicly traded? Do we reinvest in new businesses, develop new products? Do we expand the products we have on plate? These are all things questions that are being asked of the CFO sometimes on a daily basis. And so the CFO wants to understand all these different areas quickly. The way to do that is through digital platforms. That means you're going to get your accounting platform, your FP&A, your budget, your treasury outfit. There could be other financial aspects of an organization depending on industry that come into play. But you're going to have all these organizations on digital platforms that can interact, talk to each other, or provide data and information that goes to a centralized, maybe a data lake or a data warehouse, where further synthesizing of the information occurs to generate reports that can be literally on demand for CFOs and leaders to review and look at. This pace is not slowing down for CFOs. The survey shows that the importance level is much greater. I don't see that changing anytime soon.
Yeah, reading this report, I was kind of put in mind of the old JFK quote about a rising tide lifts all boats, because we've spoken a lot about increasing strategic value and the role of the treasurer. The most recent example of that is from the banking turmoil in the springtime, and just kind of the visibility that gives the treasurer. And a lot of that comes directly from the CFO. And this research kind of shows the impact that these sort of events also have on the CFO within the C-suite as well. So I thought that was quite an interesting comparison in this sort of a narrative that we frequently look at. And I think the focus on improving orders to cash that the survey mentions kind of does highlight that focus on efficiency savings that corporates have right now, with debt facilities looking generationally expensive due to the current interest rate levels. Kind of any cash that can be liberated from inefficient processes can be like lifeblood for many organizations. And you mentioned it, Paul, kind of best practice order to cash processes need various different parties to have access to accurate real-time information, and things like automating manual processes, digital invoicing, digital shipping management comes into that. There's lots of different tactics that can be looked at. And essentially a refined and efficient order to cash process needs technology, it needs process management, and it needs interdepartmental collaboration. And that's definitely something that treasurers can play a big part in improving, and obviously one that the CFO is overseeing from their level. So I think it's definitely something that corporates have a big focus on right now.
Yeah, absolutely.
Moving forward to the third story, where we will unpack the recent downgrade of the US credit rating by Fitch Ratings. Fitch has stripped the US of its AAA borrower status. Fitch issued its downgrade of US government debt, ranked among the safest in the world, from AAA to a AA+ last week after markets had closed and warned of the US economy's rising debt burden and the recent debt ceiling crisis, slowing growth and repeated threats to fiscal governance. Fitch is the second major rating agency stripping the US of its AAA rating. In an earlier debt ceiling crisis in 2011, Standard & Poor's or S&P cut the top AAA rating by one notch a few days after a debt ceiling deal, citing political polarization and insufficient steps to right the nation's fiscal outlook. Paul, How do you think this US government debt downgrade might influence corporate treasuries' risk management strategies?
Push from a standpoint of, manage a book of government agency bonds that you hold or treasuries that you hold. I don't think that's going to have a gigantic impact. As a matter of fact, if you look at what Warren Buffett's been doing, he's buying treasuries. What does that mean? Why is Warren doing that? You got to ask that question when Warren Buffett does something like that. But is this a big deal? Yeah, it's a big deal. You can't ignore it. The last time we had it, the only other time we've had this happen was S&P in 2011, noted in the article. You can't ignore a downgrade by Fitch. Now, we had responses from Janet Yellen in the White House about, that it wasn't warranted. I think there's arguments to be made that it was warranted by Fitch. I don't think that you can ignore the comments by Fitch around the issues with trying to wrangle or get your arms wrapped around what you're going to do in terms of decisions on the debt ceiling. They kicked the can down the road to 2025. That's the way I view it. They kicked the can down the road, so the problem still exists. They're ignoring it today, and they're saying tomorrow we'll come back to it. Well, that's really not a great answer. We also have, a White House right now that has expanded the balance sheet. So they're out there spending. And when you do that, it creates more debt. So we're seeing an expansion of that balance sheet. And that's something that Fitch is recognizing in this downgrade. So I think these things, if I was at Fitch and I was an analyst or somebody leading the analysis of this, I could come to that conclusion. The thing is that just because you're downgraded doesn't mean that you stay there. So the question will be, what's the reaction by our government in terms of how they make decisions? Is that going to change? Are the American people going to make the decision for our government in terms of bringing in people that have policies that align with maybe more fiscal responsibility, some people would say. So I think we could see some of that happen as ramifications of a downgrade like this. If I'm a treasurer, I certainly got to think about what does that mean in terms of cost of capital? What's that do to spreads? Is that enough to have an impact on my cost of capital? Perhaps, but we know that the way spreads work and the way rating agencies work is they look at your organizations individually and what it is that you're trying to issue in terms of raising capital. And so, I think those tend to have bigger impacts on my cost of capital as a treasurer. But I can't ignore that this happened.
Yeah, exactly. I mean, we had the news about this just before we sat down to record last week's podcast. And Paul, at the time, you mentioned that it was all about fiscal responsibility of the US government. And we did see the very recent debt ceiling brinksmanship start to maybe threaten some of the markets that treasurers rely on. It kind of threatened to stifle the ease of transaction of US Treasury bonds, which could have caused significant volatility and potentially losses for example, government money market funds that corporates were pouring their short-term cash into after the banking turmoil. So it was like, is this going to cause yet another problem? Then what do we do with our short-term cash? And like you say, the cost of borrowing could potentially go up. Will it have an impact on interest rates potentially? So I think, it's a warning sign basically for the US government to try harder to get its house in order. You both mentioned the S&P downgrade from 2011. So clearly that didn't have much of an impact if we're still, if in such a short space of time we've come back to the same sort of conclusion. So the crunch to all this might be how all the foreign governments that own trillions of dollars of US treasuries feel about this latest chapter. So, interesting times. It's one of those where it might affect treasurers or it might not, but it's quite fun to speculate about.
Yeah, no doubt.
Quite fun to speculate. That's a very interesting comment. And our next story in today's conversation pertains to the drop in global fintech funding and deals in 2023. The first 6 months of this year were difficult for the global fintech market, with total funding and deals dropping. According to the H123 edition of KPMG's Pulse of Fintech, activity fell from US 63.2 billion across 2,885 deals in second half of 2022 to US $52.4 billion across 2,153 deals in the first half of 23. Ben, the first half of 2023 witnessed a decline in global fintech funding and deal activity attributed to factors like macroeconomic concerns and geopolitical tensions. How might these trends influence corporate treasuries' approach when considering fintech investments or partnerships?
Yeah, you're right. There was a lot going on in the first half of the year that was impacting all of this. The high levels of inflation, rising interest rates, things like the conflict in Ukraine, but all helping to depress valuations. And then obviously the collapse of several banks in the US didn't help either. What I found really interesting about the report was that it also highlighted 4 trends from the first half of the year that played into the statistics of the drop in volume and number of deals, and could continue to impact the market for the rest of the year. One of those was increasing focus on operational efficiency, sustainable cash flows and profitability, both from investors and from fintechs looking to maybe delay their next funding rounds. A continued resilience in the payment space, particularly within payments infrastructure. Declining crypto funding in the wake of sector challenges, combined with the increasing focus on broader blockchain solutions, which we touched upon earlier. And then also, finally, rapidly growing interest in potential use cases for generative AI, particularly for things like cybersecurity, insurance technology, and wealth management technology. So some of those will continue and rumble on into the second half of the year, much like some of the issues that we've faced as well. So it could be another bumpy 6 months potentially, but obviously there are things that can kind of buck that trend. AI is obviously very much in the zeitgeist right now. So that will likely attract a lot of funding, I'd have thought. Even if overall fintech activity remains kind of where it is, that's kind of a trending area to look at. So I think maybe things like payments as well, quite well positioned to see funding continue to accelerate. If market conditions improve slightly, it doesn't take much for, M&A activity to start increasing again, as investors from the private equity side and even corporates will perhaps look for good deals if they can find them out there. So I think for treasurers, I don't think this should particularly knock anyone's faith in fintechs. If you were thinking about looking towards a fintech for a specific tool or a specific way to help in the treasury and cash management space and risk management as well, I don't think it should change that. It's just, I think everyone's being a bit cautious anyway in the market. So I think with treasury, that's always a good place to start. Be cautious, but, don't shut yourself down to potential opportunities that might be out there.
Yeah, man, I think those are all really good points. I don't think it's lack of cash availability out there to make these kinds of investments. I do think it's a pause, in particular on the PE side, which is going to drive a lot of these deals in the fintech area. So I think there's probably a pause. They're waiting in some respects, but not totally. We saw areas such as supply chain and logistics. Investment in that area is increasing. Not necessarily a big surprise. A lot of focus on that over the past year or two on the supply chain and logistics side. I think that's going to become more and more important when we think about how organizations want to manage their supply chains. We're seeing more and more organizations within the U.S. considering moving how they manage their supply chain from one country to another location. And in some instances, it may be onshoring or nearshoring, but it could be a country in close proximity to where they currently exist, potentially. So I think these supply chain logistics, we're going to see continue to do rather well on the fintech side. Also, the green fintech. Now, with President Biden's bill that he got passed to support a green fintech, I think we've seen a lot of investment come out of just that alone. And PE shops can see that as an opportunity and have jumped in that area as dollar funding has increased in that area. So I kind of think that trend will continue. It'll be interesting to see the second half of this year if we see some of that cash come off the sidelines. It just depends on what's going to happen with the economy through the second half of this year and what the Fed does. I think a pause may give people the opportunity to jump back in to the fintech market and make some investments.
Yeah, I completely agree. Those are some great points. Particularly, the green fintech point is really well made. I think that's a space for expansion in the next 6 months.
Yeah, definitely.
Green fintech, it is. The next news item, which is the fifth topic for today that we shall discuss, is tax transparency becoming a top priority for multinational corporations. Deloitte has released its 10th annual Global Tax Policy Survey 2023 results. The latest survey features many new topics that were high on their agenda in 2023, such as EU legislative proposals, international remote work, and the continued focus on ESG matters. In addition to respondents' views on the progress of the OECD's Pillar 1 and Pillar 2 initiatives related measures and their approach to tax transparency. The survey also found that stakeholder interest in tax will continue to increase, but is becoming the new normality. 3/4 of respondents expect some level of increase in stakeholder interest in tax behavior and outcomes of large corporates over the next 3 years. Paul, what do you think of the survey findings, and is there anything in particular that you anticipate that with these evolving tax transparency expectations that could influence corporate treasuries' communication strategies with stakeholders?
Yeah, Push, this is certainly an area that I'm not an expert in, but I found the article to be quite interesting. Obviously, communication to people outside your organization, especially with regards to taxes, has got to be managed pretty well. You certainly don't want to have a misstep when it comes to something like that. What I found really interesting about this article, where myself, being a treasurer or CFO of an organization, start thinking quickly is, do we have the right organizational structure to manage these tax changes as they're unrolled efficiently? Meaning, can we reduce the amount of tax that we pay, avoid an increase in the amount of tax, especially for, multinational entities? I think these organizations are the ones that this legislation obviously impacts significantly. You think about, I do business in multiple regions and I have cash that sit on the books and accounts, repatriating that cash back to, let's say it's a US-based organization that's a multinational. There are consequences to doing that. And so for years we had where repatriating was a big tax burden, and so they never brought it back. President Trump, when he was president, enacted a tax bill that all of a sudden we had a lot repatriation. Now we've got a scenario of new tax regime for multinational entities. They have to think about their tax strategy. So I think this bodes well for accounting firms out there to help organizations think through how they manage their taxes, how they restructure their organization to be efficient, but also, give them the opportunity to help them with the communication side of things. This was an interesting article for me because I learned as I went through it. Taxes are just such a beast. I think about just my personal taxes. I've owned a small business, had to deal with taxes with my small business, and and work for various organizations where tax regimes are just different for the different entities I work for. And it's complex. And it's one size does not fit all in this scenario when it comes to taxes.
Yeah, I thought the survey results were interesting to cover because occasionally you'll come across someone who's head of Treasury and tax, but most of the time these are two separate functions that do have sort of various points of contact along the way. Think of something like transfer pricing, for example, where Treasury and tax should work together quite closely to avoid misunderstandings and potentially risk of fines or other penalties. I think the OECD Pillar 1 and 2 is something that impacts treasurers and tax managers alike. And I just wanted to highlight one area of this that's mentioned in the survey. Pillar 2 includes the proposal for a global minimum tax rate of 15% in each territory where a group operates, calculated by a globally agreed method based on disaggregating the group's consolidated accounting profit. So where a group's operations in a territory are deemed to be undertaxed, a top-up tax charge arises that will take that territory's effective rate up to 15%. This rule will apply to all multinationals with a turnover above 750 million euros. So there's many situations where a group's business operations in a territory with a high nominal tax rate, maybe the UK, the US, Germany, can actually give rise to a top-up charge. So treasurers need to be alert to the possibility of additional tax charges and to evaluate whether the company's funding or hedging strategies would be impacted by these particular rules. Obviously, hedging arrangements are particularly sensitive to something like this 15% minimum rate, because they typically result in amounts being taxed under domestic law on a different basis from the accounts. So this can distort the effective rate calculation, perhaps causing hedges to be economically ineffective. So more than 80% of the tax professionals expect the income inclusion rule to be implemented globally by 2025, and a similar majority for the undertaxed profits rule by 2026. But 44% of all those surveyed are yet to do any kind of modelling on the impact of Pillar 2 on their tax profile. So this is something that treasurers could be perhaps prompting their tax colleagues about if they've not heard any clear plans for this, as it impacts both functions alike. And, better to get your head around this now rather than it be a nasty surprise for the business just a couple of years down the road, potentially.
Yeah, Ben, you raise an interesting point around hedging, whether it's a county hedge or economic hedge. Obviously, the tax side of things can have an impact, and something like this for a multinational can't be ignored. Most of my experience on the Treasury side, the tax side of things, I was always separated from Treasury, so I haven't experienced the tax side of things. But as a treasurer, demand on cash obviously is pretty important. And you can't ignore what's going on the tax side of things.
Absolutely, yeah. Got to pay attention.
Those are wise words. I'm going to pick on your brains for the final choice or the final topic for today. What, according to you, is the biggest, the most important story of the past week, and why? Is it the digital dollar pilot and CBDC story, the CFO news item, the downgrade of the US credit rating, drop in global fintech funding, tax transparency, or some other news item? Ben, may I ask you to do the honors first?
I think it's probably, for me, the US downgrade, a bad week overall for the US, with the US women's national team going out of the Women's World Cup down in Australia. And the downgrade is just kind of the cherry on the cake. So I think, when we were covering the story, I mentioned it's one that could impact treasurers, might not, but it's certainly, it's one to just watch and see if there's any reaction rather than just hot air coming out of Washington about this.
Yeah, Ben, my pick last week was the downgrade. It's one of those things you can't ignore. For this week, I have something slightly different, but also involves downgrades, in particular around Moody's downgrading U.S. banks. We talked about last week potential soft landing for U.S. economy. It's still somewhat in question. It was last week. It still remains in question on my mind. The Fed could be at a point that they're going to pause. Will these downgrades have further pressure or strain on the economy itself? That I don't know. Consumers still feel willing to go out and spend. And as long as consumers are spending, that's a good thing. So, but wages continue to rise. And that puts pressure on inflation. And the Fed, as we well know, the U.S. Fed is very much attuned to inflation. That is the key metric for them. Downgrading U.S. banks is certainly not something you want to see. Not at this time.
Not at this time. Thank you so much, Paul and Ben, for your insightful perspectives and informative analysis. We would also like to thank our CTMfile audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a great week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.